Hello, welcome to the latest edition of Portfolio Briefings, a series where we look at the impact of COVID-19 on pension funds. I am Mona Dole, the editor of Portfolio Institutional, and with me today I've got Stuart Trow. He is credit strategist and a trustee at the pension scheme for the European Bank of Reconstruction and Development. Thank you very much for joining us today, Stuart. How is the team?
They're, I guess, doing well and enjoying the opportunity to pick up paper at good levels in the markets at the moment.
Settling into working from home then and everything operationally?
Yeah, actually it's worked surprisingly well, actually, and on a day-to-day basis we're looking at quite a high quality credit portfolio, and there's been lots to sort of look at the last few weeks with people, good quality names, very keen to raise liquidity. So yeah, we're happy.
Okay. Have you been working from home a lot before? Or has it been a big challenge switching that around? Or
well, I always used to work from home one day a week anyway, so I kind of was used to that part of it. But it's a bit different working 5 days a week from home, and it's kind of difficult to switch off at times because your screens are just there and you have a quick look, and then the odd email pops up and all of a sudden you're sucked into something again in a way that doesn't really happen when you're when you're just looking at your phone for the odd email and stuff like that. So it's it can be a bit all consuming if you're not careful.
Yes, I can imagine. And I mean, talking about your investment portfolio, you obviously try to plan for the long term, but could you have planned for this? This seems quite a challenge.
Exactly. I mean, to be honest, I think we always took the view that we were planning for resilience, really. It is what it is. Every crisis is that little bit different from the previous time, but there are enough similarities with the global financial crisis that I think a lot of the systems were in place in terms of having the liquidity we needed and sort of having a strategy that could take us through good times and bad. So yeah, obviously with the benefit of hindsight, you might have tweaked a few things, but I don't think we've done too badly out of it.
I remember actually speaking to you before and you mentioning already that you had concerns about liquidity in credit markets. So do you feel validated in that respect?
Well, yeah. I mean, it's not like I'm running around sort of, but
Something good to be right about, I guess.
Yeah, I mean, one of the things is people were talking a lot about the liquidity provided by bond ETFs, for example, and I think kind of, whilst that's still a very useful tool, even at the institutional level, I think people will be a little bit more circumspect about that. And I think it was significant that some of the Fed measures actually specifically targeted ETFs because they realised that from an institutional perspective, they probably needed a bit of help, not to put too fine a point on it, because, I mean, you get big, at the end of the day, despite the protestations otherwise, those sort of products are liquid claims on what are generally illiquid assets. And I know ETF enthusiasts will vehemently deny that, but to some extent that is true, and it's inescapable.
So has it impacted your investment decisions so far, these dramatic swings that we've seen in credit markets?
Sort of, but not to a huge extent, because one of the sort of slightly one of the things about the portfolio we run, we are mindful of the way the bank is positioned as well. So because the bank is quite long of credit by nature of its operations, we tend to try not to be quite so long of credit. But it certainly sort of focused our thinking. The clear divergence between investment grade and non-investment grade is sort of, even though it's something I've spoken about a lot, it was an eye-opener for me as well, to see quite how friendless the non-investment grade credits were. All the issuance has been at the top end of the market, which has been great for our sort of high-quality portfolio, but in terms of the business of the bank, it's been fine as well. But it's very interesting to see that divergence in performance.
Mm-hmm. The people navigating towards the most liquid assets in a way as well. Is that what you're referring to?
Yeah, but it's more subtle than just liquidity. I think, you know, high grade is going to be supported by central bank activity, and I know some of the Fed's actions reach further down to that, including some of the high yield ETFs. But at the end of the day, it's you've had a really unusual situation. I mean, sometimes sort of safe haven assets at the beginning of the crisis were moving the wrong way, if you like. I mean, treasuries were weakening as stocks weakened, gold weakened as stocks weakened, and you know, you can only surmise that a good part of the reason for that was because people needed dollars, and you know, selling treasuries and selling gold is part of raising dollars. You know, and now we're in a sort of slightly more regularized scenario, so that if equities fall, treasuries rally. So that's kind of indicative that things have slightly normalized, although, you know, obviously that's not completely the case.
What were the drivers behind that normalization? Why has everything swung back more into like a normal?
I think because of the aggressive measures put in place by the Fed above all. Central banks have done what they can. I mean, this isn't a crisis that can be solved in any way, shape or form by central bank action, but they can try and ease us through. You know, they can be the paracetamol or whatever to sort of ease the pain, but and they can try and avoid making policy mistakes. And the thing they've done is just swamped the market in liquidity. You know, if you look at the sheer scale of quantitative easing and interventions, it dwarfs even what we saw in the financial crisis in 2008, which is just astonishing.
And people still have faith in that, even though this crisis seems to be very much rooted in the real economy rather than 2008, where.
Yeah, no, they have faith. Whether they're right to or not is another matter. Because I mean, I think at the end of the day, equities are sort of getting a bit of a halo effect from the liquidity provided to bonds, but actually equities aren't getting any direct support themselves. So it's, you know, not at all inconceivable that we'll see a second run at this.
Yeah, that was always kind of the point, and at the same time the risk of QE, wasn't it? And it should boost equity markets indirectly.
Yeah,
and
no, exactly right.
Where do you see the key risks, investment risks at the moment?
Well, it's kind of almost the unintended consequences of all this. You know, liquidity is clearly one, and you know we've seen that demonstrated in the bond markets directly, because you know secondary liquidity is very hard to come by, especially in high yield credits. But we've also seen it in the dislocations. You know, what we were talking about earlier in terms of the treasury market moving the wrong way, apparently, you know, when the crisis was at its height. And, you know, obviously dislocations, things like the oil market as well. I mean, although not necessarily directly related to it, the drop in demand that they were trying to address was related to the COVID-19 situation. And, you know, it's going to be a while before all of these sort of second order sort of effects work their way through, and you know, some of those could have quite big impacts on things. You know, I think the other thing would be looking out for, and we've seen to a certain extent, is the credit impact on the banks are sort of starting to make quite hefty provisions relative to what they did in the last cycle. So you know, obviously that's something we'll have to be looking out for more or less real time, and it might be indications from the banks that is more important to us than perhaps some of the economic data that's been released.
Can you explain it in a bit more detail, what provisions they're making?
Yeah, I mean, just regular sort of wholesale loans, credit cards, personal loans, all of those sort of things. You know, I mean, I think we were reading in the FT this morning that sort of some private label securities were performing far worse than people had expected in this crisis. And you know, another example was in that FT article this morning was that Goldman Sachs's performance on the credit side, on personal loans and credit cards, was an order of magnitude worse than that some of its sort of rivals, sort of the big traditional providers.
So the big question, I guess, is if a liquidity crisis could translate into a solvency crisis. Do you see a risk there?
I mean, the solvency crisis in the financial crisis in 2008 was whether the banking system would collapse and not be fit for purpose as a transmission mechanism for central bank monetary policy. And because of renewed sort of bank regulation, banks are in a stronger position. So that's great, but they're not in as strong a position to provide the credit to the general economy, because they kind of been a bit nailed to the floor in terms of capital and liquidity requirements. So where the regulations have been eased at the margin, in the main, they're not able to leverage up to the extent that perhaps they would have been before, which limits the impact the banks can have in boosting the economy.
Unintended side effects.
Yeah, no, absolutely. Because I mean, one of the things that I've been quite convinced about is with the European banks, the European regulators were so intent on not having another 2008 that basically, in terms of capital requirements and liquidity requirements and leverage requirements and stuff like that, they pretty much nailed the sector to the floor. Before the legacy issues had been sorted out. Whereas in the US we had TARP, and basically the banks were forcibly recapitalized within 3 weeks, I think, of Lehman failing. Whereas in Europe you didn't see that at all. So basically Europe made a recovery from the financial crisis without or despite its banks rather than because of its banks. They played no useful role, and consequently, European bank equities, for example, have massively underperformed their US peers over the last decade.
And a lot of banks have withdrawn themselves, that you mentioned it earlier in conversations that we had, from the liquidity provision in for example, bond markets.
Yes, yeah, no, that's exactly right. I mean, before, part of what I do is credit strategy, and my job changed materially with the financial crisis in 2008. All of a sudden, banks couldn't afford the luxury of having carrying bonds as inventory, or certainly not sort of credit as inventory. They could hold risk-free bonds, but and that made the secondary market disappear. Yet at the same time, the primary market grew and grew and grew, and we got to the situation whereby if you ever needed to sell, everybody seemed to be the same way, and the market would move, very quickly to reflect that.
And that's, would you say that's part of the reason why we've seen such dramatic swings? Like, things seem to be recovering fairly quickly always, but the volatility has increased a lot. Yeah,
no, that's exactly right. And the one thing credit hates is volatility. It's kind of a lazy proxy for the risk premium, if you like, and sort of high volatility is absolutely the last thing credit wants to see. And I think the other issue about that is that obviously we don't like to see that sort of volatility, but we're also sort of got to factor in the realistic probability of increased defaults going forward. Before, people would get not excited about defaults, but sort of think at some point defaults will return. Well, that's the point we've reached now. So high yield space now, we will be looking at defaults. There's no two ways. That's not something we've been very used to in the last few years.
Yeah, I suppose it's a lot easier to intervene in the financial sector as central bank rather than to intervene in the real economy and prevent defaults.
In fact, there's been a clear split. You see sort of economies such as Germany where the state banks are now an asset, whereas before the state banks were a bit of an albatross and performed a very useful role, but not necessarily in a very efficient manner, and obstructed the private sector, if you like. But in a crisis, the state banks are absolutely the mechanism by which you can quickly get credit into the economy. Whereas, say in the UK, we've experienced, measures have been put in place, but having that reflected in credit actually being advanced to companies who desperately need it, it's not really happening in the way you would hope it would have done.
Mm. I suppose the decision is very complex to make, which business to support and which.
Yeah, because at the end of the day, it's the banks that are carrying the can, not the government in this particular respect. So, yeah, they're going to be much more careful than the promises of the government.
Yeah. Now that might actually be quite a good transition to investment portfolios, such as the EBRD pension fund portfolio. What can pension funds do to reduce their investment risk in that situation and to minimize the risk by default?
Yeah, no, it's a very difficult question, because I think one of the challenges before the crisis was you often got pension funds trying to think how they would de-risk their portfolios, but it wasn't easy to sort of imagine how that might happen, because equity yields or dividend yields were still relatively attractive, and bonds were paying very, very little. So it wasn't obvious where you would de-risk from equities if you were so minded, and had you done that too early, you would have missed out on quite substantial gains in the stock market. So the way we went, and perhaps the way a few other people went, was to sort of take a bit of a barbell strategy. We largely kept our equity portfolios, but also offset that with fairly chunky holdings in index-linked government bonds and stuff like that. So it's more like a barbell strategy.
Okay.
And mark to markets aren't pretty, but they're well within our funding tolerances, and been quite gratified that it's weathered the storm to date so far. Yeah, and in terms of time management, I mean, where do you see the risk that this crisis could last for at least a year or so, if not longer? Yeah, I'd be in the if not longer bit. I think, to be honest, one of the mathematically, as soon as people start to return to work from being furloughed and what have you, economic activity will rise, and because of the quantum of the collapse we've had, it will rise quite sharply. If you fall 30%, the economy falls 30% in a quarter, and you rebound 10%, that's still not got you anywhere near back to where you were, but it's quite a nice number. And what I rather suspect is that a lot of people have lost sight of the fact that countries like Italy and Germany were almost in recession going into this, even before a whole coronavirus episode. And I think that's something that will come back to be much more apparent once people are working slightly more normally, is that there is no economic momentum behind no momentum behind the economy, added to which global trade will have been massively reduced as well. So with the disruption to supply chains for logistical, for geopolitical reasons, and what have you, costs will be biased upwards. I know it doesn't really seem like it at the moment because oil's cratering and we're in recession, but I think the bias for inflation going forward will tend to be higher. So there were times before the crisis where we were able to allow the economy to run quite hot without the risk of inflation taking off, and that was precisely because globalization kept a lid on wages. It kept a ready supply of consumer goods and industrial goods for the West's industries, whereas now, because globalization and global trade has taken a step back, we can't rely on that sort of deflationary supply side shock to keep a lid on inflation going forward. So we might be unpleasantly surprised by how rapidly inflation picks up if the economy ever were to normalise. So do you see what I mean? This is more of a problem down the track. I'm not the central banks have got to do what they've got to do at the present time, but they might be shocked that the inflation reaction function will be different going forward to what it's been for the last couple of decades. Okay, well, that's interesting. Yeah. But for a lot of pension funds could obviously also be a challenge then, because Well,
being paid up?
yeah, no. I mean, from an investment perspective, that is the challenge. I mean, do you play it safe and go into low yielding, high quality bonds,
Mm,
and possibly run the risk that if inflation does pick up down the track, and with a pension fund, by definition, you're looking at long-term investments here,
well,
or do you take the risk of an exceptionally volatile equity market with no certainty about corporate earnings?
so there could be growing demand for LDI type kind of strategies, or is there already a point where we can't really increase LDI strategies anymore?
Yeah, I
That
mean,
ties a bit into the what could asset managers also do, I guess. But this, I've seen the argument swinging around it, because of the constraints of the bond market and so on. That there's a limit to how much LDI you can implement in your portfolio.
yeah, no. I mean, that's always been the problem with bonds all the way along, isn't it? Because at every point they look expensive, and then they get more expensive. So it's
Yeah.
at some point or other that is going to crack. And are we seeing signs of that with Europe's periphery, for example? One moment they're being treated as sort of cheap proxies for pan-European or pan-EU debt, and at the next moment it's sort of we need to be treating this as credit risk, not risk-free sovereign risks.
Mm-hmm. Yeah, Christine Lagarde seems to be quite a bit more hawkish there than Draghi. It seems that might be the first impression.
No, I'm slightly surprised at that, because I had the feeling that she was perhaps more politically astute than Draghi was, and Draghi got frustrated because he couldn't quite make the politicians understand what was required to cement the union and also cement recovery, whereas Christine Lagarde seemed to be more of a polished political player, but I mean, maybe she's playing a longer game there.
Yeah, let's see. So what role do you think could asset managers and consultants play in helping pension funds in that kind of environment? It's a bit of a...
Yeah, well, I suppose one of the issues is, I mean, to make it more micro for a minute, is that sort of our members, certainly our members, and I'm sure members of other schemes are just crying out for reassurance.
Yeah.
Because very often the strategies they've got in place, the mix, and depending on how strong the default funds and the default options are, they're not terrible options there in the main.
Yeah.
To encourage people to keep the faith, if you like. And I've been, on a personal level, I've been quite encouraged that several of our members have reached out to me and asked, well, is this the sort of environment in which we should be making additional contributions? And
interesting.
yeah, no, I mean, I think, well, psychologically, it's very difficult to do all the buy low, sell high thing, but they're at least contemplating that sort of behaviour, which is sort of, especially for younger members, that's probably absolutely the way you should be going in terms of, especially for a defined contribution sort of scenario.
And in terms of investment strategy, I mean, you mentioned buy low, but suppose you never know when it's going to be at the lowest point. So that's a tricky one to implement as well, isn't it?
Yeah. No, I mean, obviously, and I mean, some at the end of the day, it sometimes comes down to the strength of your covenant as well. That in as much that you wouldn't like to go there, but if you're the pension fund of a strong company, you've got more latitude to sort of stick with it than if you're going to go to the board and say, look, we've got a shortfall on the retirement plans, that will be an incredibly big problem. So I mean, so that to some extent will determine the sort of strategies that different portfolio managers adopt, I think.
So for you in practice, for your scheme, would that mean that they would perhaps look into buying into particular assets because the valuation has become more attractive, or are you holding back with that at the moment?
We at a micro level, we're sort of fairly hands off anyway. So we've had a sort of taken a view on risk markets, and being based in the UK, I think is sort of something that's mitigated the impact to quite a considerable degree of global equities coming off, because obviously sterling sort of in sterling terms actually they've not come off nearly as much as the headline numbers would suggest. So I can't imagine us changing things very much, but we perhaps see it more of a validation of what we had before.
Yeah.
Okay. Doesn't sound
well, one last question would be, and that's a bit of a challenging question. What do you think the world will look like in a year's time?
Oh, yeah, no, that is a challenging question. I think part of it will be that we might be surprised at how little has changed, in as much that, I mean, so many people preface comments by saying I'm not an epidemiologist and all the rest of it, and I certainly am not, but sort of people far wiser about these things than I have been sort of suggesting that this will, from a DC's perspective, continue for quite some time. From as we were discussing earlier, from a mathematical point of view, the economy will probably have a big jump sometime between Q2, Q3, just as some people start to go back to work, but that will be more of a dead cat thing. And I think we will be struggling in and out of recession, maybe technical recession, for the next 24 months probably. I'd be really surprised if it lasted any less than that, simply because we've had a long run up, propelled by incredibly accommodative monetary policy. So nobody has really got a clear idea where value for any asset class is. And I think that's really going to be the problem down the track, is that the more and more of the market that central banks own with their super leveraged balance sheet, the more and more difficult it is to pick where value is, and the more and more difficult it will become for central banks to withdraw themselves from the equation.
Interesting. Thank you very much for that.
Okay.
Thanks.